Welcome to 80/20 Estate Planning, the show that explains smart ways to get the most from your estate and planning team, with your host, Al Gibbons. In this 13-week series, Mr. Gibbons and his guests will be discussing a multitude of critical and helpful topics, including his own 80/20 process. Feel free to call in with your questions, 621-WALE or 1-877-621-WALE. Now, 80/20 Estate Planning with Al Gibbons.
Welcome to 80/20 Estate Planning. This is Al Gibbons, your host, in Part 9 of a 13-part series on estate planning. And today's topic is estate planning and charitable giving. And I have two really terrific guests with me today, so let me introduce them. First, I have Stuart Sullivan. And Stuart Sullivan is at the University of Pennsylvania, but he started his career at Ronon, and he was at Ronon College from 1988 to 1997, involved in many of the areas that we're going to discuss today. But let's talk about Stuart's positions at the University of Pennsylvania. 1997 to 1999, Stuart was Director of Gift Planning at Penn, responsible for strategies related to the identifying and soliciting of planned gifts for the University of Pennsylvania. And in his progressive moves, Stuart moved to Director of Gift Planning and Major Gifts at the University of Pennsylvania from 1999 to 2000. And these experts that we have today have been intimately involved in charitable giving. During that period, Stuart's duties included oversight of a 12-person staff in 3 locations, Philadelphia, New York, and Los Angeles markets, devoted to raising major gifts, $50,000 and above, benefiting all of the schools and centers of the university. And today, Stuart is Director of Development for Schools and Centers at the University of Pennsylvania, and he's responsible for the management and strategic planning for 14 of Penn's 17 schools and resource centers. The total annual fundraising for these schools and centers is in excess of $75 million. And Stuart, we are really happy to have you with us today talking about this topic. Welcome.
Thank you very much. I was glad to be here.
Okay. And in addition to Stuart, we have the very distinguished John Hook, a partner in Trust and Estates of one of the really excellent law firms in Philadelphia, Stradley, Ronon, Stevens, and Young. And John has provided estate planning and tax planning advice for more than 14 years to high net worth individuals, executives, entrepreneurs, and owners of closely held businesses. John started his career at Stradley Ronon in the tax department and attained a master's of law from NYU, and a major emphasis of Mr. Hook's practice focuses on the tax implications of estate planning. He is currently the chairman of the Taxation Committee of the Philadelphia Bar Association's probate section. In addition, John lectures frequently in the areas of wills, trusts, and estate planning with a focus on reducing or eliminating federal estate taxes. One area of concentration for John, and a big reason that we have him on this program today, is that he specializes in planned charitable giving, and he sees it from an estate planning and a tax perspective with all of his clients. He also advises charitable organizations on the establishment and operation of a planned charitable giving program. John, thanks so much for being with us today.
Al, thanks a lot for having me.
So we have a great program lined up for our listeners today, and we're going to talk about estate planning as we have all the way through this series, and we're going to talk about charitable giving. And let's get right to it. John, in your practice with your clients, why do people give to charity?
Well, there are any number of reasons why people might give to charity. I guess with my tax background, what I end up seeing a lot of times are that there are tax-motivated reasons for giving to charity, whether the tax motivation might be that the person is trying to generate an income tax deduction, or whether they are trying to remove their assets from their estates so that when they die, they don't own as much that's going to be subject to any type of death tax, like a federal estate tax. That's the one big area, I guess, that I see so much because of my tax concentration. But I think there's a lot of other reasons that people end up giving to charity. One specific other reason is that when in the creation of entities like a private foundation, which I expect we might talk about more later, Al, you have a degree of self-aggrandizement where somebody creates their own foundation, names it after themselves, and funds that foundation with cash or property. And that lets their name live on for eternity. So it's kind of a legacy which they otherwise leave. Something that Stu might want to talk about in further detail, you also have those people who want to give because they've either been helped out by the charity, like somebody who's gone to Penn, Stu, who would otherwise continue throughout the rest of their lives after graduation to continue to give to Penn. Or you might have the individual who particularly believes in the charity's causes, the cause that the charity might have, such as maybe a nonprofit entity that might help children, a nonprofit entity that may help abused women, or certain religious organizations where a person fully believes in the cause of that religious organization, whether it just be a church, a synagogue, or any other type of religious organization.
So John, you've already brought up then three reasons in terms of tax motivation, or having the name sort of live on, or because of a belief in a cause.
That's right.
And it would seem to me, Stuart, in your position at Penn, any of those reasons could be very valid. And how do you determine which one is the motivating factor for the client?
Well, it really comes down to thorough discussions with the individual, because you can have 10 different donors giving the same amount of money, and you could quite literally have 10 different reasons behind their motivation as to why they are giving that gift. And no matter what a plain giving officer will tell you, there is still a cost with giving to charity. No matter how attractive the tax benefits are, no matter how you can structure the gift, you can minimize the cost of giving, but there is still a cost. And so a person is giving something away, and there has to be some charitable motivation behind giving the gift, meaning that they have to of course, have a belief in and an endorsement of what you are doing and the mission of what you're doing, or having been served in the past, as John said, or wanting to see some change, societal change going forward.
Well, let me ask maybe two follow-up questions to that. You say someone has to have a charitable intent. Have either of you met many people in your career who really very strongly believe in no charitable intent in their lives?
You see varying degrees of charitable intent. This is Stuart talking. And what you find is individuals who have lower charitable intent but may have a greater need for leaving a legacy behind, in the sense of having their name attached to something. Perhaps they didn't have children, or perhaps they are disenfranchised with their family, and they're looking for a way to be remembered. And that is, in a sense, a charitable intent, but it's more of a self-fulfilling charitable intent, rather than wanting to necessarily attach themselves to something that is worthwhile from a societal standpoint.
Well, let me ask the question a little bit differently, John, to you. Do people always know whether or not they have charitable intent?
No, I actually don't think people always know that they have a charitable intent. And Al, just going back for a second, just to answer the last question of whether or not I've ever run across somebody who's done something charitably without, or created some type of charitable gift without having charitable intent. While I would always tell somebody to make a charitable gift, you should have charitable intent, I've actually had two different occasions where I've had two different clients who, yes, they had some charity that we ultimately gave to, but the primary motivation was a tax deduction, or trying to save in, it was actually federal estate taxes in both cases. And it was almost weird. I was actually joking around with the client at one point where the client said to me, well, John, you just pick the charity, and as long as I can get my charitable deduction, I'm happy. And they were, so I fully believe that to properly do charitable plan giving, that there should be a charitable intent there. Sometimes you run across those individuals who would rather give the money to charity, no matter who that charity is, rather than give the money to Uncle Sam.
Well, no.
Al, let me cut in there, Al, for a second. I've got an interesting statistic where that's concerned.
Okay, good.
There was a study that was done recently that showed that among the wealthiest individuals in our population, meaning people that are multi-million-dollar net worth and several $100,000 and above of income a year, they asked several questions about the motivations behind charitable giving. And one of the questions was, how strong of a motivator are tax benefits? And among the general population of this particular population of wealthy individuals, about 53% listed taxes as a strong motivating force. But when you cut that down to individuals above the age of 65 in that group, then more than 75% listed taxes as a strong motivating force in the tax deduction and the tax benefits.
Yeah, very interesting. I just saw a study, Stuart, where they asked the question according to gender, and tax deductions, tax planning, was a more important motivator for men than it was for women. It was significant in both groups, but it was more significant among men.
Right.
But, John, you said something very interesting, and we can come back and talk about this a little bit more. It looks to me as though there's going to be an estate tax. We may get some reform, and we may increase the amount we're able to leave to our families without tax, but the fact of the matter is it looks like there's going to be a tax.
Right.
So the wealthy do have this choice you just mentioned about leaving it to a charity or leaving it to the government. Is that a fair statement? I mean, is that what happens?
I think it is a fair statement, Al. If you actually, especially when you're working with some of the more sophisticated or complex vehicles, you can actually show dynamically or financially by running the numbers how it's really a choice between where are those dollars going to go. Many people think that they're pulling dollars away from their beneficiaries, and if the client is the parent, for example, they think that they're pulling dollars away from their children who would otherwise be their ultimate beneficiaries of their estates by making gifts to charity. But there are many techniques out there, and many that we end up using, and I'm sure Stuart ends up using also, whereby you can actually show the client how instead of pulling dollars away from children, we're actually pulling many more dollars away from the government. And it's more, I guess I've described it this way to the clients, and I've seen other people describe it this way to clients. It's more if you're giving that money to the government and it's otherwise caught like a social cause, do you want the government to otherwise determine how that money is going to be used, or do you want to determine how that money is going to be used by otherwise directing it to the social cause that you otherwise think is worthwhile, and that is the charity of the client's choice?
Yeah, very interesting. And Stuart, it sounds to me, this is beginning to sound like a no-brainer to me. If my advisors ask me, would I rather leave the money to the government and have the government decide how it should be spent, or could I give it to a charity and sort of direct how it's being spent and on whom, I'd have to say I could get charitable in a hurry.
That's right. I mean, we have kind of a saying, partly in jest, but following up what John said, if you're wealthy enough, you're going to be a philanthropist one way or the other, and either you decide where the money is going or the government decides for you where the money is going.
I want to follow up on this. Let's take a break. We're right in the heart of the matter, I think, and let's come back the other side of the break and follow up on this conversation.
80/20 Estate Planning will return after these short messages. Mortality. Who dwells on it? But when it comes to planning your estate, it's never too early to start. For smart ways to get the most from your estate and planning team, you need to hear Al Gibbons, creator of the heralded 80-20 estate plan. Implement 80% of the planning you need in 20% of the time it normally takes, from A to Z in 60 days. Contact AEG Financial Services today at 610-917-8940 or email them at algibbons@algibbons.com for more information about Al's expert services and related products. Al Gibbons of AEG Financial Services is a highly respected expert in the complicated and often confusing world of estate planning. Put his years of experience in dealing with real situations to work for you. Contact AEG Financial Services today. Call 610-917-8940. That's 610-917-8940 or email algibbons@algibbons.com.
Money. It's just not what it used to be. Among other things, it's younger. But new money and old money have at least one thing in common. Phoenix, a company that's been helping people manage wealth for nearly 150 years. Phoenix understands that making money and knowing what to do with it are two very different skills. Call 1-888-456-3451 or visit us at phoenixwm.com. We can bring harmony to your life, if not to your music.
The future is now. Does your business require reliable communications, information, scheduling, and document access from anywhere, with anyone, at any time? Do you need flexibility and control? If so, then you need the services of Viable Solutions Incorporated. Founded in 1986, Viable Solutions Incorporated has a long history of unsurpassed expertise in customer care. Recognized by Novell for service excellence, let Viable Solutions put your business on the fast track with world-class power and consistent results. Viable Solutions works for you with both sales and development teams of respected vendors. As a leading expert with Novell's GroupWise and winner of numerous awards, Viable Solutions clientele includes top corporations across the United States and Canada and around the globe. Viable Solutions provides the pinnacle of service, software, guidance, and support. Contact Viable Solutions Incorporated today at www.viable-solutions.com.
Today's money. It's not just who you are, it's what you're made of. It's not just having a name, it's making one. Not just being, but creating. In fact, 8 out of 10 today's millionaires aren't inheriting their money, they're earning it. That's not just evolution, that's revolution. And one company understands how money has changed, and that company is Phoenix. Call 1-888-456-3451 or visit us at phoenixwm.com, because money is not what it used to be.
Talk to our expert host. In the Providence area, call 621-WALE. Outside the Providence area, call toll-free, 1-877-621-WALE.
And now back to 80-20 estate planning. Here's your host, the estate planning expert, Al Gibbons.
Welcome back to 80-20 estate planning. We're talking about estate planning and charitable giving today. And I have two terrific guests with me, Stuart Sullivan of the University of Pennsylvania and John Hook from Stradley Ronon, one of the premier law firms in Philadelphia. Welcome back, Stuart and John.
Thank you.
I want to follow up on this conversation that we were just having regarding directing money that is either otherwise paid in tax to the government or when we can direct it to some charity. Can you describe, Stuart, how that actually works? Can you give us an example of money that could have gone, that normally would have been paid in taxes and now can be directed to charity? Can you sort of set that scenario for us?
You know, the most basic of situations is where an individual or family or a couple decide to leave a simple bequest in their estate plan. And if they are in a taxable estate, meaning their assets for a couple are above, $1.3 million, or for an individual are above $700,000, essentially, then every dollar above that is going to be taxed. So, if you have an individual with $1 million estate and they've got $700,000 of that they can pass on to their heirs tax-free, then there's a $300,000 balance there that could be subject to estate tax. And this is an oversimplification, obviously, of the situation. But So that person could either pay, tax on the $300,000, or they could leave that $300,000 or a portion thereof to charity. And whatever they leave to charity qualifies for what's called the estate tax charitable deduction, which is essentially the mirror image of the income tax charitable deduction, which as of 2 days ago, a lot of people are very familiar with, given tax day. And it essentially allows for the estate to get a benefit for leaving a gift to, or an individual to leave gifts to charity that are 501c3 organizations in the United States. Or
qualified charities.
Exactly, qualified charities, which would be public charities or certain private foundations.
So I guess what you're saying, Stuart, is if I give it away, I don't owe estate taxes on it.
Exactly right.
Okay.
Whatever is given away, you avoid estate tax. Now, that's the most basic, and then there are some more advanced techniques that individuals can use that provide benefits in addition to the estate tax savings.
Okay, and I want to talk about some of those because there are some, as you mentioned, some income tax advantages and some streams of income and so forth that we'll talk about in techniques. But John, isn't that a high price to pay? Stuart said earlier there's always a cost to making charitable gifts. If I give it away, don't I really take it from my family? How do I handle that?
To answer the question quite bluntly, yes, you do if it's just a straight gift in the most simplest form where it's simply a charitable bequest to the charity. You're taking away, you are taking part from the taxes, but you're also taking part from the family. What you'd like to do instead, and this is the way that, in showing it to a client, usually the client thinks that it is that you're able to save them money and at the same time not take any dollars from their family, is through some type of wealth replacement technique. And many times the wealth replacement techniques that we've otherwise utilized is through some combination of making a charitable gift and at the same time using some type of life insurance product to otherwise replace the dollars that are being lost to, not lost to, but are otherwise passing to charity. As we get into the more sophisticated techniques, what we're going to see is some of the vehicles that we can set up for the charitable giving side will produce a stream of income to the client while the client is alive, and then at the client's death is going to go to charity, and that's where we get our charitable deduction from. And at the same time, while the client's alive and getting that stream of income, we'll use that stream of income to otherwise purchase or pay the premiums on a life insurance policy, and through another technique, we'll keep that life insurance policy out of the person's estate so it doesn't cause any additional taxes. But the life insurance proceeds, when the client ends up dying, the life insurance proceeds end up now passing to the family, and if we've kept the life insurance proceeds out of the person's estate, they're going to pass to the family members now tax-free. So whatever dollars we use to fund the charitable vehicle, that first charitable vehicle that produced the stream of income for the individual during their lifetime, those dollars don't end up getting lost because they are replaced by the life insurance proceeds that come back to the family. So when you look at what would the family have received if you did nothing, and what would the family have received if you used this more sophisticated planning or wealth replacement technique, as it's generally known, sometimes the family can actually make out better. There are more dollars going into the family's pocket, there are more dollars going to the charity, and there are less dollars going to the federal government.
It would seem to me, Stuart, as you put some of these scenarios together that John has talked about, that in the end, as I said at the top of the show, are there many people who are absolutely against giving to charity? I don't think that there are many who are against giving to charity. They don't know the advantages, or they could afford it, or they had never considered it. And it would seem to me that once we have the conversation, would you rather give this money to the government, or would you rather find an appropriate charity, that somebody says, well, I think I'd rather find an appropriate charity. And then it seems to me that the next step is I have to see how this impacts my family and myself if I give a gift to charity or if I don't give a gift to charity. And it almost seems to me like it's, at that point it calls for looking at some numbers and looking at Plan A versus Plan B versus Plan C. Do you find that in your practice at Penn?
That's absolutely the case. And if you are dealing with a larger charity or a charity that has been involved with some of these issues for some time and some of these complex techniques, then they probably have somebody on staff like me who has some amount of expertise in this from the charitable giving side. But it's important to draw that line where it is the charitable giving side. And I can provide, and others like me around the country can provide certain calculations and information to the donor and their advisors. But then if they're worth their weight in salt, then they draw the line and say, okay, here's the information. Now take it to your advisors and see if this makes sense. And here's a couple of options for you to discuss. And then we can be a partner in the process, working with their financial and their legal advisors to make sure that the very best option is chosen.
And so it seems in many cases, John, that Stuart just described, they may have contacts with a donor or former alumnus. They propose a concept, and I guess you would have some people come back to you and say, what do you think about this? Does this look like this has merit? And help walk me through the numbers and the considerations and the ramifications, the good news and the bad news, and help me decide whether it works in my estate. Does that how it gets to you in some cases?
Many times, Al, that is exactly how it gets to me.
Okay, then what I'd like to do is come back on the other side of a break. Let's take a quick break, and I want to talk about a couple of techniques, John, that perhaps Stuart's alumnus or alumni have come back to you with, and see how we look at those things. Right after the break, we'll do that.
80/20 Estate Planning will return after these short messages. Mortality. Who dwells on it? But when it comes to planning your estate, it's never too early to start. For smart ways to get the most from your estate and planning team, you need to hear Al Gibbons, creator of the heralded 80/20 Estate Plan. Implement 80% of the planning you need in 20% of the time it normally takes. From A to Z in 60 days. Contact AEG Financial Services today at 610-917-8940 or email them at algibbons@algibbons.com for more information about Al's expert services and related products. Al Gibbons of AEG Financial Services is a highly respected expert in the complicated and often confusing world of estate planning. Put his years of experience in dealing with real situations to work for you. Contact AEG Financial Services today. Call 610-917-8940. That's 610-917-8940 or email algibbons@algibbons.com.